When a man is 70, the math changes. That is the first truth I want you to understand. The world keeps trying to sell older people the same dream it sold them at 45. And that is one of the cruelest habits in modern finance. At 45, time can forgive a great deal. At 70, time becomes selective. At 45, a market decline is painful. At 70, the same decline can become permanent damage if it arrives while you are drawing from the portfolio that is supposed to carry the rest of your life. This is why I've always believed that the question after 70 is no longer, how do I get richer as fast as possible? The real question becomes, how do I make sure I am never forced into fear? That is a different question. And it deserves a different portfolio. I have watched this mistake repeat so many times that I no longer think of it as a mistake in the ordinary sense. It is more like a cultural misunderstanding. People are taught throughout their working lives that the answer is always more growth, more return, more upside, more market exposure, more complexity, more advice, more products, more yield. Then they reach an age where what they really need is certainty. And instead of changing the question, they keep the old answer. That is how people lose their peace late in life. They use a 40-year-old investor's playbook in a 70-year-old investor's body. Then they act shocked when the result is anxiety. I am not against growth. No one could accuse me of that, honestly. I have made my life in markets. I have spent decades allocating capital. I know perfectly well what productive assets can do over long periods. But the older I get, the more I respect one fact above almost all others. There is a point in life where the purpose of money stops being expansion and starts being protection. And if you miss that turn, the price can be severe. It is not only a financial price, it is emotional, physical, relational. I have seen it in the eyes of retirees who thought they had enough and then discovered that what they really had was too much risk dressed up as prudence. The great lie sold to older investors is that anything producing income must be safe. That lie has probably done more damage than many outright frauds. A high-yield bond fund looks safe because interest arrives. A dividend stock looks safe because the company has been paying for years. An annuity looks safe because a guarantee is printed somewhere in the brochure. A real estate trust looks safe because real estate sounds tangible. That is all surface language. At 70, surface language is not enough. You must ask harder questions. Can I lose principal? Can the income be cut? Can I get my money when I need it? Those are the questions that matter. Not what sounds respectable in a sales presentation. Not what your neighbor owns. Not what some eager advisor calls balanced. Safety after 70 is not an emotion, it is a structure. If the structure can break when you are least able to recover, it is not safe enough, no matter how many times the industry tells you otherwise. Let me tell you what I mean in plain language. A retired man with $1 million in a stock, heavy portfolio may look wealthier on paper than another man with a more conservative structure. The statement may flatter him, the average projected return may flatter him, the conversation around him may flatter him, then the market falls 40%. He is no longer simply down on paper. He is withdrawing from a damaged pool. He is selling lower to fund ordinary life. And what would have been a temporary decline for a worker becomes a permanent impairment for a retiree. That is sequence risk, a phrase too academic for a problem so human. If bad markets arrive early in retirement, the portfolio may never recover to the path it might otherwise have taken, because withdrawals are interacting with losses at the same time. That is one reason older investors can be ruined by risks younger investors survive with a shrug. It is not because the market became more evil. It is because their own time horizon changed. The tragedy is that many people do not really accept this emotionally. They still see themselves as the competent investor they were in their best working years. They remember the rebounds. They remember how buying the dip once worked beautifully. They remember how their bravery in earlier bear markets was rewarded. That memory becomes dangerous. Experience can be a wonderful teacher. It can also become a flattering liar. The 70-year-old investor tells himself he has seen this before. What he has not seen before is this exact bear market arriving at this exact age with this exact dependence on the portfolio. That is the difference. And that difference is everything. I think of a man I once knew who retired with more than enough money by most ordinary standards. He had saved diligently, invested steadily, and entered retirement with the confidence of a person who had done the right things for decades. His advisor had him in a portfolio that was called moderate. I have never trusted the labels in finance very much. Moderate is often an aggressive portfolio wearing a polite tie. The portfolio had a great deal of stock exposure, some bond exposure, a little this, a little that, the usual seasoning of complexity people add to make something look professional. Then the market broke, not forever. Markets never break forever, but they break long enough to hurt. His portfolio fell hard. He saw numbers evaporate that had taken him 30 years to build. He panicked, which is one of the cruelest words in finance because panic rarely begins as hysteria, it begins as self-protection. He sold at the worst time because he could not emotionally tolerate a future in which the losses deepened. He moved to cash after the damage had already been done. Then the market recovered without him. That pattern is older than I am. He did not run out of money immediately. That is not how these stories usually work. He ran out of confidence first, then he ran out of generosity. Then he ran out of plans, travel got cut, then gifts, then family gatherings became shorter because every cost felt like an argument with the future. The portfolio had not only lost value, it had stolen ease. That is a very expensive loss late in life. I want you to notice something. The real wound was not that he failed to maximize return. The real wound was that he lost the right to stop thinking about money every day. That is what safety should buy you at 70. The right to stop living in constant calculation, the right to know that the next roof, the next car issue, the next dental bill, the next help needed by a grandchild, the next piece of life will not force you into financial fear. Once you understand that, the whole investment conversation changes. You stop asking what could earn the most. You start asking what can fail the least. That is not cowardice, that is maturity. At 70, the great investment problem is no longer ambition. It is fragility. And fragility comes from three places: the possibility of losing principal, the possibility of losing the income stream, and the possibility of needing cash at the wrong moment and not being able to get it without pain. That is why I think truly safe investing after 70 is a much narrower category than people realize. The industry hates narrow categories because narrow categories do not produce enough products. The industry prefers confusion. Confusion creates fees. Simplicity creates boredom. And boredom does not pay sales commissions. So I am going to give you the simple answer, because simple is what works when you no longer have the time or the need to play games. If I were 70 and responsible for protecting every dollar I had built over a lifetime, the first investment I would insist on is short-term United States Treasury securities. I do not mean long bonds. I do not mean clever ladders involving exotic credits. I mean Treasury bills and short Treasury notes, short maturities, plain paper, simple promises. The reason is not glamour. The reason is mathematics. The United States government borrows in its own currency. It taxes in that currency. It issues in that currency. It settles in that currency. People love talking about debt ceilings and political theater as though they were deep investment analysis. Most of that is noise to the older investor seeking safety. The real question is default. And in any ordinary sense relevant to retirees, short-term Treasury obligations are the closest thing to a default-free instrument the world has. I have no use for fantasy here. If you are 70, you do not need to prove how adventurous you are. You need assets that still behave like assets when the world becomes impolite. A 6-month Treasury bill does that. A 1-year Treasury bill does that. A 2-year Treasury note does that well enough. If you understand what you own. This is what people miss. Short-term Treasuries do not only protect principal from credit risk, they also largely avoid the worst form of interest rate risk. That is why I am not sending you far out on the yield curve. A 30-year bond may have the same government behind it, but it behaves very differently when rates move. Long bonds can produce ugly mark-to-market losses. A retiree who does not need that kind of drama should not volunteer for it in the name of an extra bit of yield. The point is not to squeeze every last basis point from the fixed income sleeve. The point is to keep the money boring enough that it continues doing its job. A 1-year Treasury bill does not ask for admiration. It asks only that you understand what role it plays. You give the government money for a short period, it gives you the money back with interest. No earnings call, no dividend committee, no activist investor battle, no management misbehavior, no balance sheet mystery. Just a short duration promise backed by the strongest credit structure available in the system. That simplicity has tremendous value, especially in old age, and right now, unlike many years in the past, you can actually get paid something respectable for that simplicity. There were years when cash and short treasuries earned almost nothing. That forced many retirees to reach out on the risk curve because they felt there was no other way to produce income. Today, the picture is different. Short-term government paper can offer real yield, not fantasy yield, not speculative yield, real yield with actual liquidity and principal protection. That is a gift older investors should recognize. If I had $1 million at 70, I would want at least half, perhaps more, depending on my temperament and circumstances, in very short, very plain U.S. government paper. Maybe 50%, maybe 60%, maybe more if my health were poor or my emotional tolerance for volatility had diminished. The exact number is less important than the principle. The foundation should not wobble. That is the whole point of a foundation. The next thing I would own is far more controversial to people who think safety means avoiding all stocks after 70. I disagree. If you are 70 and healthy, there is a good chance you still have 15, 20, perhaps even 25 years ahead of you. That is not a short period in market terms. That is enough time for inflation to matter very seriously. And inflation is the quiet killer of people who overprotect themselves into stagnation. If you put everything into ultra-safe short instruments and nothing into productive enterprise, you may preserve nominal value beautifully while slowly weakening purchasing power. That is a different kind of danger. So yes, I would still own stocks at 70, but I would own them in the simplest possible way, a low-cost SP 500 index fund, not because I have lost my respect for business analysis, because at 70, the purpose of the stock allocation is no longer to demonstrate insight or chase brilliance. It is to preserve a claim on the long term growth of productive American enterprise without requiring constant supervision, heroic decision making, or dangerous concentration. I have always liked the broad American business engine. It is messy day to day and extraordinary decade to decade. That sentence matters because older investors often remember only the daily mess. They see volatility. They see headlines. They see crashes. They do not always fully appreciate how the broad market over long enough periods has a remarkable habit of surviving wars, recessions, political stupidity, inflation scares, banking panics, and every other form of temporary madness. Individual companies fail. The broad productive base evolves. That is the virtue of an index. You are not marrying one CEO, one product, or one industry. You are buying the broad habit of American business to adapt and continue compounding earnings over time. That matters enormously when you still may need the money to work for another 20 years. But notice what I said, a portion, not an act of faith masquerading as courage, not 70% because you once thought you were aggressive at 50 a portion. Enough to give the portfolio long-term growth and inflation protection, not so much that a bear market can steal your sleep. If the short-term treasuries are the floor, the index is the growth engine sitting on top of the floor, maybe 20%, maybe 30%, maybe slightly more if you have pension income covering most expenses and a strong stomach for volatility, but always with the understanding that this portion is for the later years, not the next 3. This is where people get confused. They say stocks are unsafe. That is true in the short run. They say stocks are safe over long periods. That is also true in a broader sense. The real question is whether the investor's time horizon matches the instrument S nature. At 70, part of your capital still has a long horizon. Part of it absolutely does not. That is why all or nothing thinking is so destructive. The older investor who owns no stocks at all may defend himself from volatility only to surrender purchasing power over time. The older investor who owns too many stocks may get crushed by sequence risk and panic exactly when he can least afford it. The solution is not ideology. It is proper allocation. This brings me to the third holding I would insist on, and in some ways it is the most underrated: cash. Not as a permanent portfolio strategy, as a reserve. Real, accessible, no-drama cash. Enough of it that life cannot push you into selling anything important at the wrong time. I have said before that cash is to a household what oxygen is to the body. People notice it mainly when it is missing. A year of spending in cash is a reasonable place for many retirees to begin. Maybe more if the household is more conservative, if health costs are uncertain, or if peace of mind requires thicker walls. Maybe less if there are extraordinary other income sources. But the principle, again, matters more than the exact number. You want enough liquidity that the market does not get to decide your timing. That is power. A retiree who has to sell stocks into a bad market to pay for ordinary life is not in control. A retiree with a proper cash reserve can let the equity portion recover, let the treasury portion roll, and let time do some work. That is a completely different emotional experience. People sneer at cash in bull markets flatter fools. I want something more durable than flattery. A man with a proper cash reserve does not panic when the market drops, because the grocery money is not tied to the ticker. The dentist is not tied to the ticker. The furnace is not tied to the ticker. The airplane ticket to see the grandchild is not tied to the ticker. That separation is priceless. And because it is priceless, advisors trained to optimize for return often undervalue it. They measure yield, I measure human behavior under strain. A structure that helps the owner behave intelligently is often superior to a theoretically higher return structure that practically leads him to do stupid things. That is the older investor's problem in one sentence. The structure must be strong enough not only on paper but in the body. Can you live with it? Can you hold it through stress? Can you avoid turning temporary loss into permanent loss? That is why I keep returning to simplicity. If I were 70 with $1 million and ordinary retirement needs, I would want something like this: a majority in short-term treasuries, a meaningful but restrained portion in a broad, low-cost equity index, and a proper reserve of immediate cash or cash equivalents. That is it. Not because there are no other instruments in the world, because very few other instruments improve on this combination when measured by the standards that actually matter after 70 principal protection. Reliable income, liquidity, inflation defense, behavioral survivability, that is the list. Now I know what many people will say: what about high dividend stocks? What about preferreds? What about high yield bonds? What about private credit? What about annuities? What about real estate? My answer is the same in each case. What problem are you trying to solve, and what new fragility are you importing to solve it? High dividend stocks can cut payouts. High yield bonds can default or reprice brutally. Private credit can gate or hide trouble behind stale marks. Annuities can lock your money behind surrender penalties or depend on insurance structures. People do not truly understand. Real estate can be illiquid, management-intensive, and highly inconvenient exactly when age makes inconvenience most costly. I am not saying none of these can ever have a place. I am saying they fail the simple test too often for me to call them the core of true safety after 70, and that word matters, core. Could a rich, sophisticated, highly organized 70-year-old with massive surplus funds own a rental property or a select individual dividend stock? Of course, that is not my question. My question is what sits at the center of the structure when your job is to defend a lifetime of work from the twin dangers of market loss and personal panic. That is where my answer becomes very narrow very quickly. The truly dangerous thing about many retirement products is that they are sold with the word safe while importing exactly the kind of hidden fragility older people cannot afford. A bond fund sounds safe until rising rates teach you that fund duration still matters. A stock with a 40-year dividend history sounds safe until the business changes. An annuity sounds safe until you try to get your own money back and discover the price of the guarantee. A balanced portfolio sounds safe until the balance turns out to mean too much stock exposure for a person whose working years are over. This is why I distrust labels and trust structure. Labels are for marketing. Structure decides the outcome. The older I get, the more I appreciate enough. That is not a slogan. It is a financial philosophy. A great many people over 70 no longer need to win. They need not to lose badly. They need not to panic. They need not to become a burden to their children. They need not to spend the final decades of life checking account values with a knot in the stomach. That is enough income, enough safety, enough liquidity, enough growth to offset inflation without exposing the whole structure to ruin. That is a very satisfying word once you understand it properly. Enough the financial industry does not like enough, because enough does not generate endless activity. Enough does not buy a new product every quarter. Enough does not invite cleverness. Enough is stubbornly unexciting. And yet, if you are 70, enough may be the finest financial target in the world. The point is not to die with the highest statement balance. The point is to live the remaining years without financial dread. The point is to know that the check will clear, the medical bill can be paid, the market can stumble without taking your nerves with it, and the family gathering can happen without your having to calculate every mile of driving. That is wealth at that stage, not maximum upside, minimum fear. I think many people fail to appreciate how much safer simplicity becomes as life gets shorter. A complex portfolio can impress younger men. A simple portfolio can protect an older person. And protection is not the enemy of wisdom. It is often the final form of it. You have already learned enough lessons by 70. You do not need new pain disguised as sophistication. You need clarity, you need assets whose behavior you can explain in plain English to yourself and to your spouse over breakfast. This part is in short treasuries because it must be there when we need it. This part is in the broad market because inflation and time still matter. This part is in cash because life has terrible timing and we refuse to let bad timing force bad sales. That is a retirement structure. A real one, not a brochure, not an aspiration. A structure I would add one more layer because it matters. Whatever the allocation, it must allow you to sleep. This sounds soft to people who worship return statistics. It is not soft. Sleep is a risk management tool, a structure that produces a slightly higher expected return but causes bad behavior during stress is not actually superior. I have no use for theoretical greatness that collapses in the body. If you cannot live with a 30% stock allocation, lower it if your pension and Social Security already cover most of life. Perhaps lower it and enjoy the peace. If you have extraordinary longevity in your family and abundant other reserves, perhaps you can push a bit more into equities. This is not religion, it is architecture. Architecture is adjusted to the building and to the weather, but I would still begin with the same three materials: short treasuries, a broad low cost equity index, cash. I have seen too many older people hurt by chasing one extra point of yield or one extra burst of growth because somebody persuaded them they still had to keep winning. You do not. You only need to remain secure. That is a much easier mandate, and in many ways a much nobler one. The whole game changes once you accept that. You stop asking which investment will make me richest. You start asking which arrangement will let me live freely, give sanely, help where I want to help, and leave this world with order rather than disorder. That is the right question after 70. And the right answer, in my judgment, is still stubbornly simple. Protect the foundation, own enough growth to stay ahead of the silent erosion of inflation. Keep enough cash that the markets never get to dictate your behavior. Then stop obsessing and go live. That last part is more important than many people admit. Money is a servant, a fine servant, a dangerous master. If a sound structure can buy you freedom from daily money worry, then it has done its job better than a more exciting structure that keeps you mentally chained to every headline. That is why I call these three holdings truly safe. Not because they eliminate all uncertainty from life. Nothing does, because they eliminate the forms of financial fragility that matter most. When time is shorter and peace is more valuable than applause. And if I were 70, responsible for guarding the fruits of a lifetime of effort, that is exactly what I would want. Not brilliance, not complexity, not the thrill of one more big bet. I would want sleep income I could trust, cash I could touch, growth that could still work quietly in the background, and a structure so plain that it could not easily lie to me. That is safety. That is enough. And at 70, enough is a very beautiful word.